Good morning, all. It is Tuesday, the 24th of May. And last week, as you recall, I was talking about the End of Slavery Tour, which went really, really well. We had a Friday night event, and then we had a Saturday event. The Saturday event was put on by somebody else, but we put out the Friday night event, had 500 people confirmed. And what was interesting is probably about 300 of the 500 showed up, maybe a little bit more than 300, but it's interesting how things go when people get excited to hear something, right? And they say, "Wow, I can register and get the tickets for free." Some paid. There's a different experience for those who paid, and those who didn't pay had kind of like a general admission, first come, first serve. But look at a large percentage of them did not show because there was no cost associated with it. Therefore, in my opinion, human nature, they didn't value it as much because they didn't have something that they were losing. Even though the information was valuable enough that they got excited to jump in on that, wanted to hear about it, listen to Tim Ballard and Unity Park, but it wasn't valuable enough for them to show up because they weren't losing anything by not showing up. And I'm sure, who knows, the timing may have been off too, in the sense that we did it while people were setting up for graduation parties and things like that. So ultimately, we did miss out on a few people coming. Got the next one coming up first part of July. I believe it's July 8th or July 9th in Phoenix. So anybody who's in the Phoenix area or close by and you're watching this, be ready to go to endofslaverytour.com. It's not up yet, the exact dates and where we're going to be, but just know it's going to be in Phoenix first part of July. So what we got going on in the market today? Well, we've got the stock market's kind of taking a bit of a beating, which is kind of interesting. And with that happening, we started to see that certain indexes are dropping from their highs, and we're seeing that that's starting to look a little bit more bearish. You know, the information I've been provided that once the index is down 10% of its highs, it's considered a correction. When it goes down 20% or more, it's considered a bear market. Now, the NASDAQ itself is down over 30%, while the S&P 500 is at 19%. You know, the S&P 500 makes up 83% of the total stock market, and the 5 top stocks within the stock market, Apple, Google, Microsoft, Berkshire Hathaway, those guys, those are 20% of the S&P. So it's very, very important, the S&P. And when it reaches bear market territory, we might see some higher acceleration with respect to the stocks are concerned. Now, this might have quite the effect on the economy. So what's been noticed is that when the general traders or people's portfolio starts to lose value, that value can impact how they spend money, right? So the consensus is that for every dollar they lose, they spend 5 cents less or 5% less on what they would have normally spent, right? They don't have quite the confidence to go out there and start buying things because their wealth is shrinking. Right. So as this continues to shrink, we might start to see that inflation may taper back a little bit. We're not 100% certain here. Of course, this is just speculation based upon data that I've seen. But I don't think we've reached peak inflation either, because same source, we still have China with the lockdown in Shanghai and some of those. Once those lockdowns end next month, we're going to see major energy consumption, or it could be some other spike in inflation. So I don't think that we have ridden inflation completely out yet, but we'll see how that all plays out. Let's look at our charts and see what's going on in the mortgage-backed securities pools. Here we are. So you can see I've drawn my trend lines and a channel here. So we have finally, what I believe, definitively broken sideways, right? We have tested this floor a couple of good solid times. And now we've tested this ceiling. Looks like several times we've tested this ceiling and found that this is pretty formidable ceiling. We got a pretty formidable floor. Looks like we've gotten further away from this particular downward trend. I think we have at least a sideways channel that we can play in these swings here. It's a pretty broad range, but it gives the people to sell off quite a bit and then be able to pick up and make up some capital when they hit those bottoms. So I think this particular channel is going to give us a little bit more stability in the market and a little bit more stability in the rates. I can't say for certain, right? Because we've seen this play out before. But ultimately, I think that our pressures on the downward side may be eased up a little bit, especially with what's happening in the stock market. So I'm not one that's going to really, really freak out about where we're about things. But I also know inflation's still crazy. And once we start seeing what's going on, the lockdowns released in China, that could have some influence And if that influences inflation negatively even further than where it is today, that could have an impact with respect to the mortgage-backed securities, could push those rates higher. So I'm gonna leave the same consensus that I have every single time that we've ended one of these in the last few months. Lock if you've got something to lock on, and don't look back. Period. We can play the market all we want, but I don't know what the market is one to play with. Not in these days. We have so much uncertainty, so much going on, so many shortages, and so much demand and pent up demand that's coming. We know it's coming. It's been talked about by everybody. We know it's going to hit when it does. That I don't know what the effect is going to be. I don't want to speculate the effect. I don't want to play with your future. I want to say lock it in, go with 30. Don't go with the short-term stuff. I've got a lot of people asking me, what about ARMs? I'll get better cash flow first couple of years. What about your 5, 6, 7? Right? You're going to raise rents. You're going to go up. You're going to make up for all that anyway. Quit worrying about this year. Too often people are stressed about right now. Quit thinking about that. Think about year 3. Think about year 4. Think about the increases in rent raises. All right. We never know how things are going to go with the housing market. So you may want to not put yourself in a position where you're going to be forced to refinance unless you want to pull cash out. And pulling cash out is your discretion. But if you get an ARM, you're going to be forced into that refi. You don't have a choice at that matter, right? More than likely. I can't say for certain. I don't know what's going to happen in the rates in that over that period of time, but you have a greater chance of being forced into a refinance that you're not wanting or needing, and you don't know what the market's going to be at that time. So just let you know, 30-year fixed, get some certainty in your life, secure your costs for a very long period while you can adjust everything else according to the market. See you guys on Friday.